Our guest this week is Jerry Neumann of Neu Venture Capital. Jerry is a wildly successful early-stage investor and one of the best writers and thinkers about the craft. We talked about how he thinks about whether AI is a consensus trade in venture, the theory and reality of portfolio construction, and the origin story of an investment that returned 5,000x for him. We also talked about the reception to a book that Jerry co-authored with Liz Zalman, founder versus investor. I really had fun with this one. Please enjoy. Jerry, thanks for coming on the show.
Hey, Joe. How are you?
I'm good. Longtime reader of your posts and listener to your podcast, following your work. So it should be a fun, nerdy conversation.
Right.
Maybe to get things rolling, you could tell listeners a little bit about your background in your own words.
Okay. So I'm a venture capitalist. I have been investing in startups since 1997. So for a while now, I took a break in the middle to start my own company. So I went and worked at a corporate venture fund in 97, was there until 2003, started my own company with a couple of other people and did that for about 4 or 5 years. And then started investing again. So in 2008, I started investing again, this time with my own money. I call myself a venture capitalist rather than an angel investor, just because I wanted to focus on the professionalism of the job. So it's not a hobby. It was how I paid my bills. So that's what I've been doing for a really long time. I'm an engineer by background, electrical engineer. And I was an electrical engineer for about 3 years before I decided I didn't want to sit in an office all day and not talk to anybody. That's me. I teach a class at Columbia University. I teach a class on entrepreneurship at the engineering school at Columbia.
I first came across your work 2017. Is a blog post you've written called Power Laws and Venture Portfolio Construction. It's been a long time. I don't expect you to remember all the finer points, and it's a really technical piece. But I'd love to get you rolling on the general premise of power laws and venture portfolio construction.
Yeah. Well, that was actually the second power law post I wrote. And they were both pretty popular. Like, they say in publishing that for every math equation you put in something you write, you lose half your audience. So given the number of people who finished those posts, I think the people who started it must have been in the trillions because there's so many math equations. It was born out of this idea that everybody in venture capital talks about power laws, that the outcomes are power law distributed. And a power law has the fattest tail of any probability distribution. So, meaning that you have far more events that are really unlikely or really unusual. No, that's the wrong word. Not unusual. That are big, right? So you have a bunch of, for power law, you have a bunch of companies that don't do well for startups, and then you have a few that do abnormally well. These are, in another context like the black swans, right? So people say venture returns are power law distributed, meaning that you have a lot of companies. If you invest in a portfolio of 100 companies, 50 of them will go out of business, another 40 will do okay, and then the other 10 will do better than okay. And the best couple will do 10x, 20x, much higher returns than you would expect from like a normal distribution. So everybody says this is true, that these returns are power law distributed. Most people who write about it just kind of leave it at that. Right. It's like, so you read 0 to 1, he's like, oh, returns are power law distributed. This means that you should shoot for the moon. It's like, okay, well, can we get into a bit more detail? I mean, this is a probability distribution. You can actually do the math on this. What does it mean? And so that's what I set out to do, was to do the math. And it's some really pretty interesting things about it, right? So the power law distribution, which kind of looks like, it looks like an inverted hockey stick. It starts out really high and then kind of goes down towards the x-axis and, out towards infinity, right? So there's the shape of the curve. How steep is it? How steep is it at the beginning? And then how far does the tail go out? That's the shape. And venture capital returns have a really steep shape, meaning that there's a much larger tail than you would otherwise assume. And then the interesting thing about that is, it's a distribution, right? So the sum of the area under the curve is 1, as all probability distributions do, right? There's a 100% chance of anything happening, right? Or of something happening, I should say. But the chances in the tail are pretty high compared to what you would think. And the average, like the average outcome, is infinite. So, which says that if you take random samples from this power law curve, on average, the sample you'll get would be infinity. And of course, this doesn't really make any sense. I mean, because you're not pulling anything out of the sample and getting infinity. It just means there's no cap on what you can get, and no cap you should expect. Whereas if it was a normal distribution, a bell curve, like the average is right there in the middle, right? The 5'9" or 5'10". Okay, so the math I did was said, well, all right, so what does a portfolio look like? If you're an investor and you invest in a bunch of companies, what should you expect to happen, right? What kind of outcome should you expect? The simple answer is, well, you should expect infinity, right? Because that's the average of the distribution. Now,
Sounds
nobody
high.
I know has what?
Sounds
Seems
high.
Yeah, I don't know anybody who's gotten that. But when you think about averages, right, it's like the average person and the average family in America, the wealth is like a couple $1 million. That doesn't mean that the median is, right. Like most families don't have a couple $1 million. It's just that a couple families have billions of dollars, right? So the average skews high. It's the same, right? So the most portfolios will end up with a 1x return or a 2x return. They'll return the money or twice the money. But then some portfolios return like 15 times the money, right? So the average then gets skewed higher. So the analysis I decided to do was, well, what's the probability of beating a certain threshold, right? And that's so the post talks about it. It actually has a table at the end that says, all right, if you want to get a 5x, you should have, if you want a 50% chance of getting 5x or better, here's how many companies you need to invest in, right? And it shows that the more companies you invest in, the better chance of getting a better return, right? And this is just kind of falls out of the power law math, which is if you have an infinite mean, then the more companies you invest in, the closer you get to that mean. Then in this case, it would just mean the higher the average return would be for the portfolio, which is, I think people have kind of taken to heart, or people have been doing, right? So you have a lot of venture firms, especially seed stage, will invest in a huge number of companies, right? The 500 startups model, we're investing in 500 startups, or the Y Combinator model. I mean, how many startups has Y Combinator invested in? I mean, it's hundreds per year, right? And this is a rational strategy in a sense where the more you invest in, the higher return you should expect. It grows slowly. The percentage, or the probability of reaching a certain return grows slowly. And I can't remember the numbers off the top of my head, but it's like, well, you have like a 10% chance of getting a 3x return if you have 20 companies, something like that. And if you want to double the chance of return, you have to like multiply that number by like 100.
Yeah,
right?
I've got a stat from it where you give an example. There's a 25% chance of a 3x return with a 20 investment portfolio, but you have to increase the number of investments by 20x in order to get to a 50% chance of a 3x return.
Yeah. So, I mean, in the end, what this says is that the returns of venture funds are just going to be all over the place, right? I mean, it's like, yeah, okay, 3x is sort of that's what people aim for, right? People are like, I want to get 3x. And if you get 3x or better, then you've done a great job. And if you get less than that, all right, if it's more than 1x, you've done okay, but it's nothing to write home about. But if it's 25% with 20 companies and you have to get to, a huge number of companies get 50%, well, it just means that you're not going to hit it every time, right?
Well, I think to that point, and what I think is interesting is, kind of towards the end of the piece, after you kind of lay all this out, show all the math, and you get to this place where it's like, okay, maybe a smaller portfolio is more rational than what the output of all these numbers would say.
Yeah. So, and this may be a bit of a rationalization because I am an old school investor. I invest in 5-6 companies a year. In the 15 years I've been doing it, I think I've invested in maybe 55 companies. So I invest slowly. I also invest at the very earliest stages, usually right about when the founders are starting the company, before they've taken any other money. And I would not feel comfortable investing in 100 companies a year or even 50 companies a year, I would not feel like I was choosing the right companies to invest in. So this, part of the reason I wrote this was to think about this kind of dichotomy in my thinking, right? Where, on the one hand, the math says invest in every single startup you can find, right? And on the other hand, kind of my heart says, well, that's not a good way to do this job. So there's two rationales that I propose. I'm not saying that these are true. I'm just proposing them. One is to get that shape of the curve that venture capitalists get in the power law. You have to be able to. You're basically choosing the shape, right? Venture capitalists seem to be choosing a specific shape of curve. Because if you look at other types of things, if you look at the stock market as a whole, the shape is different. If you look at patents, something which is sort of pre-company, they're also a different shape. Like there's all different kinds of shapes. And I don't think venture capitalists go out and say, "Gosh, what shape power law do I want?" They do have certain like norms and ideas about how to invest that kind of bring you to this particular shape that venture capital seems to inhabit. And I think the way they do that is they have to pick the right companies that fit the model. The companies that fit the model are the ones that are not risky, but they're uncertain. Like if they're risky, then you can't have an infinite return because risk is measurable, right? So, but the ones where you just don't know what's going to happen, so you have to find these companies. And if you're investing in 100 companies a year, the question is: are all of those companies that kind of company? Do they fit this metric? And if they don't, then your shape is going to be different, right? And if your shape is different, it's less, there's a less of a fat tail, then you really, might as well just be investing in public equities. So this is part of it, which I think is you can't just go out and invest in everything you see and get the right shape. And then the other one goes completely contrary to the premise of the blog post, which is I do think that as an early stage investor, you should be helping people start their companies, right? You should be, especially the founders I work with, many of whom have never started a company before and maybe never even run anything bigger than a small department. They just need some advice. Like, how do I get off the ground? How do I raise money? How do I set up? How do I put option plans in places? Things like that, right? And I think if you're not doing that, then the companies will be less successful and maybe won't really ever get off the ground. And there's only so many companies you can do that with a year.
And to your point, if you're an investor and you're not looking to be hands-on and supportive of your companies, then you're kind of in an odd place. Like you should just go back to public markets where those companies aren't going to listen to you anyway, and you can be completely hands-off.
Yeah, although plenty of founders don't listen to me either, but yes, agree. It's funny though, because saying that you can improve the odds of companies succeeding kind of goes against the core of the model, which is this is a random process. So I've never squared that circle. Is it, the fact that this power law seems to pop out every time you look makes it seem as if it really is a random process. And maybe it's only a random process at the market level, not at the individual investor level. But it does seem, I took the returns of Y Combinator's portfolio, as far as I could tell, and matched it to my returns. I'm like, oh, look, we're on the same power law curve, right? Which shouldn't be surprising if outcomes are random, but it was still surprising to me, which is not to say that, I have done as well as Y Combinator. Obviously, they've invested in a lot more companies, and they've invested at much cheaper entry prices than I have, so their returns have been better. But I've had as many outliers as they have had, percentage-wise, and I think that's probably true of most investors.
What's the piece you've written that's generated the biggest response?
Probably, there's two pieces that have generated the biggest response. One is more academic. It's called Heat Death. It's about venture capital in the 1980s. I'm pretty proud of the piece. It was a ton of research, but it's been cited in all sorts of books. And so anyway, the other piece that has been the most popular is the exact opposite. A venture founder that I had backed was fired by their board, and I was pissed off because I did not think they should have been fired. And I wrote a blog post that was based on an email that I sent to founders when they were having trouble with their boards about how to manage their boards. And the piece was called, Your Board of Directors is Probably Going to Fire You. And I, it generated a bit of controversy. I had a lot of the venture investors that I work with regularly email me and tell me I was a jerk. I had a lot of founders email me and tell me they wish they had known this beforehand. I think it was fairly obvious advice in some sense if you've done this before, which is as a founder, you need to manage your board, not have them manage you. That's how you keep your job, right? The board is your boss. They have the power of hiring and firing you. And if they've hired you, it's because they don't want to manage your company, right? They want you to manage the company. If you keep going back to the board and asking them how to manage your company, they're going to decide that you don't know what you're doing, which would be a fair assumption, right? But that one hit the top of Hacker News, and so it became probably the most popular thing I've read.
And was that the spark for, we haven't talked about the book, but last year you had a book come out, Founder vs. Investor, which you wrote with Zalman. It's a great book, which I highly recommend. You wrote, it's an interesting premise of a book where you kind of write on different topics, kind of going back and forth from a founder point of view, an investor point of view. I think it's a great read for founders and investors. It's been a while since the book came out. I think it's been a year. I'm curious, what about the response to the book has surprised you?
It's funny. So Liz is raising money for a new company right now. And I've had a couple of venture investors call me and say, hey, I'm looking at Liz's company. She has a great track record, obviously, starting two companies that did really well. But I'm worried about what she said in the book. And, it's funny because I think what she said is what every founder thinks. They just don't say it to their venture investors, right? So I said, well, what are you worried? She says, well, if she was going to do it again, she would try to give everybody common stock, not preferred stock. I said, are you worried that she's going to convince you to take common stock? They're like, well, no. I'm like, okay, so what are you worried about? This is what she wants, but it's still a negotiation. On my side, I think I had several venture investors tell me, people who had read early drafts, say, I don't think you should publish this. I don't think that you should be associated with it. You should just take your name off. I think the stuff that Liz says is too radical, et cetera. Whereas the founders kind of went to Liz and said, this is the most useful advice I've ever gotten. And to me, it really proves the point of the book, which is that there's this dichotomy between what founders want and what investors want. And not talking about those differences doesn't solve them. It just sweeps them under the carpet until there's a crisis, at which point they all pop out and everybody, gets screwed. It's like, let's talk about this. Liz is going to tell you what founders think, and I'm going to tell you what investors think. And we're not going to compromise. We're not going to find some middle ground, because in that kind of situation, there's not a middle ground in what people think. There's a middle ground in what people end up doing, but it depends on, the circumstances. Telling people well, here's the middle ground you should take is worthless advice. Understand the person on the other side of the table so that you can negotiate with them or work with them, right? So that was the point of the book. And I think the reaction to the book really showed that people were resistant to understanding the person on the other side of the table, which was kind of the point of the book. So I feel in some sense that we kind of failed in getting people to be like, oh yeah, that's a good idea. I should read this so I understand the other person. They kind of read it and they're like, I don't want to understand the other person. So, okay.
Well, I think it sparked a lot of conversations on both sides. And even if people didn't necessarily agree with points of view, it's good that the conversation's being had. And, was this perspective from the book? I mean, when I read it, it's definitely the cask strength. It's not diluted. It's unfiltered. But at the same time, to your point, it's like, look, if this is the internal monologue that's going on with a lot of founders, then if you're an investor, you should at least be aware of that, cognizant, and think of how you want to approach those conversations.
Totally. I mean, she said things in the book where I was, it's an unusual book in that I wrote half of it, she wrote half of it, but it wasn't that we combined our two halves. We actually kept them separate. It's like, you'll have a couple pages of me and then a couple pages of her responding to me and then a couple pages of me responding to her response to me. And we go back and forth. And every time she wrote something that seemed sort of conciliatory, I was like, you can't write that. You got to take that out. And every time I wrote something where I was kind of like, well, sometimes the founder's right. She's like, you can't say that. That's my job. So we really tried to make it more polarized because we wanted to make that point. So it's an unusual book. But I do think, if you read it and it is kind of the internal monologue. I was saying I was surprised at something. She wrote something once, and I was reading the draft, and I called her up. I'm like, "Really? You thought that about me?" She's like, "Oh, I didn't think that about you." I'm like, "Okay, yes, you did."
Just everyone else who invested in the rounds that you were in, but not you
exactly.
specifically.
Well, she was talking about a specific round where there were like 5 investors. I was like, "Okay, well, there's a pretty good chance that when you said that the investors, that one of those was me, and that I was also in that group." But it's like things I don't know if I wish I had known it at the time, but it would probably be good for me to have known that it was possible she was thinking that, just as it would have made me a better partner in the company.
So when you sit down with founders today, you have a first conversation with them. Let's say this is after you've invested. How has that experience or conversations from working through the book, talking more in depth, has kind of impacted how those early conversations go?
The founders don't bring the book up with me. And I suspect it's because they agree with Liz and I'm disagreeing with Liz, but they still want my money, So, so I haven't had that conversation with founders. I've really had it with other venture capitalists who disagree with me. But, I don't know. I thought I was pretty fair in the book. I tried to be honest, it's, if I don't make investments, I want the founders I invest in to be successful. That is really my primary goal. But if their being successful means I don't make money, that's not what I want either. It is, I have to measure what I do by how well the companies I invested in do and whether or not I make money from that, right? Otherwise, I can't tell if I'm doing a good job at this or a bad job. It's just inevitable that that's the metric. So while I didn't get into this for the money, there are easier ways to make money. I do feel like if I don't make money, then I've failed in that company, right? And so, I just tried to be honest about that. If you come to me and be like, hey, we've decided to become a nonprofit, I'd be like, okay, well, that's not really what I want. I had a founder from a company that I invested in a long time ago it's been going sideways for a decade, call me and say, he never raised money beyond the convertible notes, beyond the safes, actually. And he said, so, one of the investors asked if I could just pay him back from the profits of the company, the amount that he invested. And this company's never going public. It's never going to be bought. And I said, well, I think that's a reasonable thing for him to ask. He invested to make money and he just wants his money back. He doesn't want to own a piece of your company for the rest of time. And he says, but I don't have to, do I? I'm like, well, no, because safes don't have any protective language that way. So you don't. He's like, I don't know why I should. I'm like, okay, well, it depends on what you promised them when you took their money, right? Like you took their money saying, I'm going to build this company and make you money. And now you're saying, I could pay you back, but I don't want to. So, to me, it was a bit of a, it felt unethical in a way, not illegal, just felt like, well, that's, you should do what you say you're going to do. And in this case, that's make money for your investors if you can. Anyway, so yeah.
When you sit down with founders after you've invested and work with them, what are the areas that you really try to drill into them? Or would you say the key things that you want to hammer home with them in early conversations?
That's a good question. So I think I don't tell the founders what to do. That's not my job, right? I invest in founders who know what to do. The conversations I have with founders early on, aside from when people ask me for specific advice, which is usually pretty general, things like, where should I incorporate? Nothing like, how should I write this code? I think the conversations I have are typically around like, look, here's what you said you wanted to do, and here's the timeline you gave me, and here's what you are doing, and the timeline that sort of that implies, and they're not the same, right? So it's a bit more of a, you need to get back on track to achieve the goals that you had said you wanted to achieve. It's a much more general conversation around kind of the high level, goal setting processes, what you should be doing with your time. I mean, I was a founder, and I found when I was a founder that it was super easy to get lost in the weeds. Like, you could spend a month doing something, and at the end of the month, you're like, I did this thing. And then you realize, like, hey, this thing, it took me a month to do this, and now I'm a month behind in my plan because I was really just focused on this thing instead of focusing on the big picture. I think the founder has to focus on the big picture.
Yeah. I talked to a founder who was running what had already become a public company. This was in Australia's tech company. And he talked about importance of prioritization and getting lost in the weeds. And he gave this example of customers. They had a bunch of customers come to them complaining about a specific feature they wanted to see that had to do with putting something into a PDF. And they had enough people kind of pound the table with it. They're like, okay, we're going to prioritize this. It turned out to be a fair bit of work for putting it together, but they did it. And after all that, they found fewer than 1% of users actually use this new feature. And them, it was a real come to Jesus moment on, okay, we need to be tighter with our focus and prioritization.
Yeah, I mean, I think it's often a hard transition for founders who have come from being workers, actually doing the work, to being managers. And in the earliest startups, being both, right? You're both the person doing the work and your own manager. But the idea of like coming, I don't know if you ever worked for anybody else and now don't work for anybody else, but when you stop working, right? It's like all of a sudden you're like, well, what should I do? Like there's nobody telling me what to do. Like I just have to decide what to do. And if you don't have, when you're a boss, when you're managing people, you're like, okay, well, I have these things that I want done this quarter or this year, and I'm going to make sure people are doing them, and we're headed, we're on progress. Like that's your job. When you work for yourself, if you don't also do that job, then there's nobody doing it, right? So I just think people leave a company, they start a company, they get a bit lost in not having a manager and not being the manager themselves because they have to do the work. So my goal is to remind them, not to manage them, but to remind them of that part of the job.
Is that the part with first-time founders you find they trip over most often, or is there something else?
I would say no, because it's fairly easy to remedy, right? It just requires like sitting down with them once a month and being like, hey, what'd you do last month? What are you going to do next month? Okay, let's compare what you did last month to what you said a month ago you're going to do next month and see how we're doing, right? And once you do that a few times, people kind of get the idea of like, all right, the things I say I'm going to do next month, I should actually do. The hardest thing with new founders is, it could be a couple things. One, it's often the co-founder relationship. I'm sure you've seen this, right? People start a company with somebody because they worked with them before, or usually not because they worked with them, but because they like them, they're friends, they think they have the skills, and they find it hard to work together. That's always hard. And then the other one I think is embracing the uncertainty. So the idea that when you try things, you don't know what's going to happen. You can't really know what's going to happen. I mean, even your example with the PDF, like they probably could have done more research to say like what, do some sort of minimum viable product there, or do a concierge MVP or whatever to say, how are our customers going to react if we end up doing the work to do this? But you can't know how they're going to react beforehand, really, for most of this stuff. I mean, if you could know beforehand, then Apple would have done it, right? So I think that's also hard for people to embrace, the idea, well, I don't know what's going to happen. And I might try something, and then the customer's like, nah. And then you're like, okay, well, I just wasted that time. Now I have to try something else. But that's okay. That's actually just how progress happens in that environment, So you shouldn't be upset about it, and you shouldn't be stubborn about it. You should listen to your customers and try to do the best you can. You're finding your way through a maze, right? And a lot of that's just kind of going this way, dead end, all right, go that way. So that's hard for people to accept, especially people who've come from bigger companies.
I'd like to get you rolling on the trade desk. So a massive success. You invest in the seed round. It's now public company valued at ballpark 48 billion. I find sometimes it gets not quite underestimated, but probably isn't talked about as much in venture as some more consumer facing wins because it's a B2B and it's a little behind the scenes and fairly technical. But I'd love to hear more about your thinking with the investment originally and how that played out.
Yeah. So my startup ended up doing some ad tech very early on, like right when the early ad exchanges were getting started. So I knew a bunch of those people. And when I left that company to start investing again, I had a thesis on ad tech, and I knew a bunch of the people in ad tech. So I was getting some deal flow there. But my thesis, so the reason I started investing was I had this theory about uncertainty. I know I keep saying that word, and I wanted to test it. So I said, all right, well, if I'm going to, do this the right way, I have to think about this with the idea that I don't know what's going to happen, right? So I believe in that people will buy ads programmatically somehow. Like they're not going to keep picking up the phone and faxing, purchase orders to, media companies. They're going to buy them over the computer, right? I mean, that was my thesis, and I think that was kind of unarguable. But how that's going to play out, I just had no idea. So way early back in my blog, I had written this post about here's 5 ways this could turn out, right? Could be that the ad exchanges are the center of everything. It could be that the buy side platforms are the center, or the sell side platforms are the center, right? There was just 5 different scenarios. And in embracing this idea of uncertainty, I said, all right, well, I shouldn't weight these scenarios. I should just say one of these 5 is going to work, but I don't know which one. I can't know which one. So I invested in all 5. Actually, I didn't invest in an exchange because they were already up and going and further along than I would invest in. But the other 4, I invested in all 4. So one of those was the buy side platform. Jeff Green was introduced to me by another venture capitalist who said, we love this guy. We have no clue what he's doing. We just don't understand the space. We don't understand if it's a good investment. So he and I sat down. He was interested in me because I had come out of one of the advertising companies that he wanted to partner with. And we sat down. He told me his story, and I was like, "Well, I think I have no idea if this is going to work or not. Seems unlikely, but I love you, and it's one of my 5 scenarios, and I'm putting money into this, and you're the best person possible in this scenario. So yeah, I'm in." And Jeff was really, I mean, you don't meet many founders like Jeff, and you can tell from day one that they can run a company. They could run a big company. They could run a small company. So that was the easy part, was betting on him. But yeah, no, I mean, it was, I can't claim prescience. I suppose, as a venture investor, I should I knew from day one it was going to be, a multi-billion-dollar company. But anytime anybody says something like that, it's absurd, right? Because if you knew from day one, why did you invest in all the companies that didn't become multi-billion-dollar companies? Like, why did you do that? Obviously, as an investor, you think all of your companies might become billion-dollar companies. That's the point. So I certainly believed that. But Trade Desk was kind of, it's an example of a company that for a long time you think is not going to succeed, and then it does. So they had a hard time raising their first round. And they had a hard time raising their second round. It was and I think it was entirely an insider round, the second round. I can't remember. And then they just really had a really hard time raising their next round. And in response, what Jeff did was he just didn't spend much money. So, he would go with his sales guy, and they would, get in the old station wagon and drive down to see a client, and they would, share a motel room. I mean, it was really very low cost operation until they started to pick up. And one of the great things about Jeff was he had no ego there. He's like, yeah, I'm staying in a motel room with my head of sales. It's not great, but this is how you build a business. He's not like, I need a private jet. I need to live in Greenwich, Connecticut. He was the right person. The flip side of that is that when he did finally raise his big round of money, he didn't need it. He didn't need the money at all. And he ended up using 90% of it to buy, or 80 or 90% of it to buy back early investors' stock, and then went public a year later. I feel bad for the people who sold him their stock, because the company has actually done, I think, as well since IPO as it did pre-IPO. It's it's crazy. And I think, they, all of ad tech was the idea that somehow we could compete with Google, right? Like that whole premise of ad tech was, Google owns this, but we can compete with them. Or we could shave off some tiny part of this market and become really big companies. And he really is competing with Google. So I think that's, Google's a monopoly, but to the extent that you can compete with Google in the market, he is the person who's doing it. It's a great company.
I'm curious for your take on this, but something that struck me as interesting about the Trade Desk relative to a lot of other massive venture home runs is that they didn't approach the market, and you'll have a deeper perspective on this, but from mine, they didn't approach the market with a view of, we're going to totally disintermediate this market, or we're going to disrupt this market. It seemed that they were like, agencies are huge. They're deploying massive amounts of money for their clients. They want to do this better. We're not going to try and disrupt the agencies. We're going to partner with them and help them deploy into this new platform, new mediums, much more efficiently. And that may sound, maybe that sounds quaint or obvious, but so many startups I talk to, you take fintech, for example, where everyone's like, we're going to disrupt Visa. We're going to disrupt MasterCard, disrupt the banks. And here it was, we're going to bring a different perspective and channel to the incumbents and just help them succeed. And I'm curious, like, am I reading that correctly, or
no, totally. It was one of the things I liked about Jeff, because I also believed that. I did come out of, so I worked for Omnicom, which is one of the big 3 holding companies in the advertising space. I didn't work in the advertising sector. I worked, I ran their venture fund, but I had seen a lot of it, and I did not believe that the agencies were going away, because that's just not how clients bought advertising. Some big clients, Procter and Gamble, could run their own advertising in-house. They're big enough for that, right? But for the most part, people need somebody else who's an expert they can outsource to. And it's not like advertising agencies are expensive, right? They just don't charge that much money for what they do. And they can hire people at a relatively low cost because it's a glamorous industry, and et cetera. So there was no reason to say that these companies should go away, that they're sucking so much money out of the ecosystem. It's just not true. I mean, look at their revenue, or look at their gross revenue, right? After they buy media, it's just not that big a piece of the industry. So this is different than like the banks, right? Where, in the end, when you start a company in an industry, you've got to figure out how you can make some money. And unless that industry is growing incredibly rapidly, the money you make is the money somebody else who's already in the industry is going to stop making, right? So if you're going into banking, where the industry makes a lot of money, right? The banks make a lot of money. You probably have to take some of their money if you want to become a big company. Whereas in advertising, you've got to take somebody's money, but it's not the advertising agencies, because they're just not taking that. That's not the biggest piece of, not the biggest profit pool. Trade Desk is much, much larger than Omnicom is now. They're larger than probably, and I haven't checked this, but probably larger than the 3 biggest holding companies combined. It's just, and they do it by helping those holding companies, the agencies inside those holding companies, be more efficient, be more successful. So everybody wins there. If somebody's losing, I'm not sure who. It's not the clients. Maybe it's the media. I don't know. But yeah, no. I believe this as well, and I also hear this pitch all the time. Especially with AI. Oh, we're going to have AI write advertisements so that you can have advertisements more, the creative part more cheaply. I'm like, really? So you're going to displace all of these 22-year-old, college grads who are working for $30,000 a year? Like, that doesn't seem really worth it. It's just not. People aren't spending that much money on creative. It's not a giant profit pool to go out and seize. So yeah, no, I believe that, and the reason, one of the first things Jeff and I did when I invested was he wanted to meet Omnicom. He wanted to go in and talk to them. He wanted to partner with them. And, I walked him into the offices there and introduced him to the people who buy media at Omnicom, the guy who's in charge of the umbrella media buying group. And they, that's where they started in doing that for the agencies. So it was, totally. I think it was a genius thing to do. I think he thought about it the correct way. He'd been in the industry previously, so he knew what he was doing. he knew what he wanted. And, I don't think you're a mid-sized company. You're going to just avoid the agency entirely and go do it, straight, do everything yourself. It's just, it's not a feasible way of doing things.
You mentioned AI there. You've been investing in the space for, at least as I can tell from listening to old podcasts from several years ago, you've been investing in the space for a while. Obviously, it's red hot now. Curious, and knowing from following your work that you're, we'd say, is a price-sensitive investor, and correct me if your views on that have changed. How do you think about new capital going into AI today at angel, pre-seed, seed?
I have my opinions on the market, which are a bit colored by the fact that I'm a contrarian, right? That's my job. And every venture capitalist says they're contrarian, but if they're investing in AI right now, they're not a contrarian, obviously. I love, one of the reasons, like with Trade Desk, where we had a hard time scratching together the first round for Jeff. Nobody else believed it, So, that ends up being a better investment, I think, than one where everybody believes it. I've seen investments where people are like, oh, we have a pool of investors. We have 80 people interested. We're doing uncapped notes, things where you're like, why would I do this? And there's absolutely no potential financial return here for me. The company, usually that's with somebody who's, a previous founder who's done very well. And I understand why people are excited about it. But if you can't make money, then, being part of a successful company doesn't mean much, right? Like as an investor. I guess that's how I feel about AI. It's, I do have some reservations about the hype. The technology, I think, is amazing, right? I mean, the technology is crazy. It's, write me a Shakespearean sonnet on, interest rate changes, right? It's like, okay, it does, so it does things. It reminds me of a line in the, what movie was it? That Will Smith movie that they made, I, Robot, where, and I don't think this was in the original book, but, Will Smith says to the robot, he's like, oh yeah, well, can you write a symphony? Can you create a beautiful oil painting of the sunset? And the robot looks at him and says, can you? So I feel that way about this technology, right? Like it does things I can't do. I mean, I'm sure I could write a sonnet about interest rate changes. It would probably suck and it would take me like 3 days. So yeah, the technology is like magic. On the other hand, it's not and can't be human level intelligence. I mean, it doesn't do what humans do in thinking. And it can't evolve from what it's doing to what humans do, right? So there's this great book that came out recently called The Origin of Intelligence. I don't know if you've, I think that's the name of it. It came out, great book. It talks about the evolution of the evolutionary stages of becoming intelligent, and when you get past the third stage, it's like, oh, okay, well, one of the things that humans do is they simulate their actions, their own actions, right? If I put my foot here, what's going to happen? And a lot of animals do this. And then the next stage is they simulate other people's actions. If I say this, what are they going to say, right? And this is a big part of our thinking. This is not what AI is doing, right? AI is doing maybe the first 3 stages. It's learning and repeating, but it's not doing past that. So, well, I think the technology is amazing and magical. I don't think that it's going to replace humans in general purpose, general purpose jobs, which is fine. I mean, I think, there's plenty of places to use the technology. A couple of the companies I've invested in are using it as a tool, makes part of what they're doing much easier. But what they're doing is not being an AI company. They're doing something else and using AI as a tool. So that's great. I also think that if you could have invested in one of the early AI tool companies like OpenAI, that also would have been a great investment. But that's already passed. So yeah, I'm not investing directly in AI companies. And most of what I see people saying they're going to use AI for is doesn't seem that exciting to me. And then the ones that do seem exciting are, $50 million pre-monies for, 2 people and an idea. And that's, you can't make money doing that. Not on a portfolio basis.
I normally ask investors the end of a conversation the best way for a founder to get in touch. But I instead want to ask you a different question, which and you can answer that. But you mentioned in a few years ago that early stage investors want to make themselves known and available. to contact, but not too available.
Yeah.
And I'd be curious to hear why that is and how you manage that personally, especially after, at this point, you're very, very well known in the space. I'd imagine many investors or, founders would love to have you, as one of their first investors. How do you approach that?
It doesn't matter what I say because, over the past 10 years, every young founder has turned to cold emailing everybody. And it's, the traditional response is, look, you need to be introduced to me by somebody I know. And literally after, how long has it been? Like 28, 30 years in venture. I mean, I've met tens of thousands of people. I mean, just met, people who have my email address. Like you could just walk around at random and be like, hey, you got Jerry Newman's email address? And there's like a 1 in 10 chance they do, I mean, it's just, it's exaggeration, obviously, but I mean, it just isn't that hard to find somebody who has my email address. If you can convince them to send me an email saying, hey, you should really talk to this person, they're great, I'll talk to them, right? I mean, that's what I do. If you just, I get a lot of these cold emails like, oh, I was talking to John Doerr, like somebody who's like famous who I don't even know. And he suggested I talk to you. I'm like, well, he's got my email address. Why didn't he just email me himself? Like, why are you going around him? It's kind of a weird thing, but people do that now. And then also everybody buys email lists. So in the past 2 months, this is kind of a weird thing. Somebody in India put my name on an email list, which they must either be giving out or selling, because I've gotten literally 300 business plans from India. And I invest locally, right? I mean, I like to be able to sit down with the founder and talk to them and see them personally because I'm just old that way. So I'm not investing in India. I don't go to India that often, and haven't been there in decades. So it's just I'm the wrong investor for those companies, and yet they still email me. So I've gotten to the point where it's hard to read my email. So I really think like if you're not, I know I'm old school this way and people don't like it, but it's just not that hard to get introduced to me. Like anybody can. You just need to know somebody else in the startup world. I don't know.
Well, on that note, I really appreciate you coming on the show. This is really fun for me. One of the reasons I started doing the show was an excuse to have conversations with people who I respect and would have fun talking to. And so it was great to use this as an excuse for us to talk.
Thanks, Joe. It was fun.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.